pricing decision as well as transfer pricing. Today we are going to discuss about generally accepted accounting principle as well as accounting standard and AS. So we will put little emphasis because this topic is very large as a content, but we will put an emphasis on Ind AS because that is more relevant as well as it is more somewhere interesting for today. So we are going to take over the generally accepting as an introduction, small introduction, and then we will start the Ind AS. So I am sharing my PPT with you, please. Okay. Generally accepting accounting principle and accounting standards and as well as Ind AS. What exactly the we can say what exactly the generally accepted out accounting principle, where it came. Firstly, we actually used to think that accounting is a art of recording, classifying, summarizing financial information. As the case, art accountancy also involved the use of one creative skills to maintain the records of financial transactions. However, if free rein is given to the system of accountancy to be followed, there will be no limit on the scope of the manipulation of the account. So in market, what used to be happen, because it was a art, people used to manipulate the accounts as per their own requirement and used to somewhere justify it with the art form and used to tell the excuses that we believe this, we thought this, and this was not the right thing for all the stakeholders. In an environment where financial statements are presented to external stakeholder such as investor, bank, stock exchange, revenue department, government, etc., there arises a need for accounting framework on the basis of which the financial transaction should be recorded so as to make the resulting financial statement comparable. This need led to be forming a generally accepting principles. So thus GAP was incorporated. Basic accounting principle and guidelines were there. Accounting standard usually issued by the premier accounting body of the country like ICAI. Industry specific accounting practices to cover the unusual scenario where we wanted that rubber industry should follow this, the uh, electricity industry should follow these accounting practices. The pharma should go with this. The principle behind the gap was business entity assumption because we actually used to think that my the concept especially important while recording the financial transaction of a sole proprietor when the entire business with its assets and liability belong to the proprietor. The financial transaction need to be distinguished between those related to business and those related to proprietor personally. So what used to happen that people used to make every expense into the business. So what happens? My profit declines, and because of the profit decline we end up by paying less taxes. So gap was there who actually told that business entity is different, it has their own identity. That used to be the principle of gap. Next was the monetary unit assumption. What monetary assumption is? It should be recorded in the books of accounts of the business. All the financial transaction of the business should be capable of being expressed in monetary unit. It should not be like the love you cannot express into the monetary term. But yes, everything according to business need to be recorded as per the rate, as per the market rate, as per the fair value which is provided in the industry. Accounting period was also mentioned here, like financial year is been mentioned from April to March in India. Okay, so this principle entailed that the accounting process of a business should be completed within a certain time period. which is usually a financial year or a calendar year. Thus, every transaction which relate to a particular accounting period will form a part of the financial statement prepared in this period. Next was the going concern assumption. We actually believe that business will not go anywhere. They are not going to die at any time. The assumption is important because if business entity were to liquidate in near future, it would have a restate its assets and liability in accordance with actual amount that could be realized or payable as case may be. So as to reflect true financial position of an entity, we need to think that my business is a going concern. So business entity is assumed to be going concern. It will continue to operate for an indefinite time period. Okay, full disclosure principle. Full disclosure principle requires entity to disclose all the financial information relevant to investor, user, or assist him to make the informed decision. It because of the disclosure only a person can decide, do I need to buy the shares of that company or not? Do I need to give that bank need to think about this, that I need to give them, do I need to give them a bank loan or not? So every stakeholder should have the same information and disclosure need to be taken care. At transaction level, this is done by recording a adequate narration and every transaction and financial statement level. This is implemented by providing notes to accounts also. An accounting entity may not independently be able to provide all the relevant information relating to transaction, but full disclosure principle require entity to disclose all the financial information. Okay, next is the matching concept. What matching concept? When we are using double entry, then we need to match everything together. So this, and also for the particular period as well. Like if I tell you about that this expense is related to next year, that means I need to account it in the next year. Okay, so this matching concept we need to taken care when we are recording the expenses. The concept required to revenue for the particular period to be matched with the correspondence expenditure so as to show the true profit for the period. That should be here also. Actual basis of accounting. What is the accounting basis? As we are doing cash or cash equivalent is relevant spend, earning of income, incurring on the expenditure is important irrespective of corresponding the cash flow. So we need to see the actual basis accounting. We don't need to see the cash base. So we, that's why we are going with the actual basis of accounting in the gap. Okay, materiality, it is important for the business or not? You need to see that is this relevant information to be given, that watchman is not absent? No. So we need to see the materiality of the disclosure also. The principle allow an entity to disregard another accounting principle if result of sum does not affect decision making of a user of a financial statement. We don't need to say that I have increased 2% salary of someone, or the accountant was absent at the 10 days for 10 days. That is not relevant for the accounting statement. There is no, if you are making a profit, that doesn't make any materiality. Okay, certain errors or the omission may also be ignored if there is effect of immateriality in the immateriality to the financial statement. For example, when a fixed asset is purchased, matching concept require entity to recognize expenditure over useful of his life. If the entity purchases a keyboard of 300 rupees and turnover of such entity is in crore of rupees, it would be immaterial to user for financial statement whether such a asset to be recognized or as a expense it need to be recognized. Thus, even if computer keyboard is considered as an expense in the purchase, it would not be violating basic accounting principles. This amount involved an impact of same as immaterial, because 100 crores of assets are there and we are talking about only rupees 300. You are wasting my time. This is the materiality concept comes. Conservative. Conservative, as the word say, It is a process of accounting. One might come across various situations where there are two equally acceptable way of accounting for a particular transaction. One might even have to choose between recording a transaction or not recording the same. In such situation, a conservative approach should be followed. This means that while accounting for a particular transaction, all anticipated expenses or losses will need to be accounted for, but all potential income and gains should not be recorded until actually earned and received. Because I am going to pay the tax if I have received, I have recorded my potential incomes and gains also. Somewhere I am manipulating the turnover also. So this is the way of provision of expenses like bad debts is made, but there is no corresponding record provided for the increase in the realizable value of asset. Okay. So next is conceptual difference between accounting standard and Ind AS. Okay, so what is the Ind AS and what is the accounting standards? So accounting standard play a crucial role in maintaining uniformity, transparency, and comparability in the financial reporting. The transition from one regime to another, to accounting standard, to the new era of Indian accounting standard, that is Ind AS, represent a significant shift in Indian financial reporting landscape. Okay, the article delves into the intricate concept between accounting standard and Ind AS, highlighting the evaluation, regulation framework, adoption process, and key areas of diverse. We are going to talk about the differences. What is the difference between the firstly regulatory framework? AS was issued by the Institute of Chartered Accountant of India prior to the adoption of Ind AS. They were based generally accepted principle, generally accepted accounting principle prevalent in India. In contrast, Ind AS is based on the International Financial Reporting Standard (IFRS). Okay, so aiming to converge Indian accounting principle practices with the global standard. We wanted our accounting to be understandable by the person who is living in UK also. So we are actually somewhere standardizing all the accounting with the international standard. The introduction of Ind AS was mandated by the Company Act 2013 for certain companies based on the size, nature, and listing status. So, if you are a public company, you have to go with the Ind AS. But if you are a private limited company, you have to reach certain net worth and certain turnover to implement, to come into the ambit of Ind AS. Okay, so adoption process is also there. AS were voluntary because it was not mandatory to for the company and allowed company to choose between various options, leading to delivery diversity in reporting practices. But in the case of Ind AS, okay, mandatory specific companies to adapt these standards, leading to the more standardized approach for the financial reporting. The transition to Ind AS involved significant change in recognition, measurement, presentation, and disclosure of the financial information. Principle versus rules. Principle versus rules. Accounting standards were rule-based, providing details, guidance, and specific accounting treatment that you should do with this or with this or with this. Maybe you can come with another idea. But Ind AS adopt a more principle-based approach, focusing on the underlying substance of the transaction rather than merely adhering to the strict rules. Okay, so this shift promotes professional judgment and allow for flexibility while maintaining the essence of the faithful representation. So what is the rule versus principle? Where I am going with the principle, and I will be definitely will make some informed decision, as well as I will analyze what I am doing. But in case of rules, I am blind, I am going by the rules. So what happens? There are chances I could be wrong with the basic principles. Okay. So next it comes impact on financial statement. What is the impact on financial statement? First was shift from AS to Ind AS bring out the substantial changes in financial statement. Key areas to impact include revenue recognition, financial instrument and leases. Okay, under Ind AS, revenue recognition based on the transfer and of control rather than risk and reward, impacting how revenue is recognized over the time. Ind AS also introduced the fair value measurement for the financial instruments, leading to potential fluctuation in the reported value. There is a conceptual difference. What was that? That was a fair value measurement, leases, and financial instrument. What I told you earlier. Okay. So what happened in the fair value accounting? That require Ind AS requires company to measure certain asset and liabilities at their fair value, reflecting market price. This approach enhances transparency, but can also lead to volatility in the financial statement. But Ind AS places a greater emphasis on the fair value measurement compared to AS. Okay, so what happened here? The already we have made a point that we need to think about that fair value need to be taken care without any other values. Okay, so lease is also there. Ind AS 116 introduced a new model for lease accounting, require lease to recognize most lease on balance sheet. Okay, the contrast with AS, which operating lease were not recognized on the balance sheet. Change enhanced transparency by despising lessee and lease related obligation and the asset. So we have decided that if it is a financial lease and if it is a operating lease, lessee will become a owner of the product and they have to make it clear into the balance sheet. Okay, financial instrument. On the hand, or it require entities to categorize financial asset into the various categories based on their business model and contractual cash flow characteristics of the asset. This is a departure from simpler classification under AS. Okay, so next we come to the impact on industry. What is the impact on the industry? So we can see banking and financial services came after 2019 compulsorily because of we can see that banks are not running properly. So we have put them into also into this impact. This was the four phases of the Ind AS where we can see the industry is also becoming real estate sector faces the challenge in revenue recognition and measurement of lease assets also. Different industries are affected differently at the transition of Ind AS. Okay, disclosure requirement is also there. Ind AS place a greater emphasis on the disclosure of ensure that user of financial statement have a sufficient information to make informed decision. This lead to enhance the disclosure requirement compared to AS. Okay, so there is a we can say here the conceptual difference between AS and Ind AS is underscore the involving nature of financial reporting standard in India. Before we used to do was a very conservative approach. Now we are doing more of a principally correct approach. Okay, so Ind AS represent a significant step towards global convergence while accommodating the unique needs of the Indian business environment. The shift involves changes in regulatory framework, adoption process, principle versus rule, impact on the financial statement and disclosure requirement. Embracing these differences in the essential for the business and profession to navigate the dynamic landscape of financial reporting. Okay, applicability of Ind AS. The applicability of Ind AS was not dropped on the head of India just like that, like GST or the other laws which have been introduced recently. It has been introduced to Indian market by the phases. The Ministry of Corporate Affairs in 2015 had notified the company's accounting standard A&AS Rule 2015. It came after the Company Act 2013, okay, which stipulate the adoption of applicability of Ind-AS in the phases manner beginning from the accounting period 2016-17. So MCA has since issued three amendments rule, one in each year, 2016, 17, 18. Amend the rule of 2015. Okay, so NDAS are basically standard have been harmonized with the IFRS to make reporting by the Indian companies more globally accessible. Okay, since Indian companies have a far wider global reach now as compared to earlier, the need to converge reporting standard with the Indian standard was felt, which has led to the introduction of IND-AS. So how phases of IND-AS has came, MCA has notified the phase-wise convergence to IND-AS from the current accounting standard. Okay, so how they come with the phase one, phase two, phase three. So phase one was mandatory applicability to IND-AS to the companies from 1st April 2016, provided it is a listed or unlisted company, its net worth is greater than or equal to 500 crores. Okay, so net worth shall be checked for the previous 3 years, that is 2013-14, 14-15, and 15-16. That was the phase one. In the phase two, mandatory applicability of NDS to all the companies from 1st April 2017 if it is listed company or in the process of being listed as on 31st 3 2016, or its net worth is greater than or equal to 250 crore but less than 500 crores for any of the below mentioned periods. Which period? Again 2014-15, 15-16, and 16-17. Next was the phase 3 mandatory applicability of NDS to all the banks, NBFC, insurance company from 1st April 2018 whose net worth is more than or equal to 500 crores with the effect from 1st April 2018. So what happened? IRDA, IRDA, Insurance Regulatory and Development Authority of India, shall notify the separate set of NAS for banks and insurance companies with effect from 1st April 2018. NBFC include core investment companies, stockbroker, venture capitalization, etc. Net worth shall be checked for the past 3 years, 2015, 16, 16, 17, and 17, 18. Okay, so next is phase 4. Phase
Can we just
4.
call it bank more than it is a banking company because with the form of a company.
Sorry. Okay, maybe by mistake there is a mic open. Okay, what was the IND-AS? IND-AS was actually given a guidelines to know the accounting and used to implement into the reporting system. Okay, so IND-AS is 1, 2, 7, 8, 10, 11. They are notified IND-AS. Okay, first was presentation of financial statement. How you will presentation makes any difference, we will discuss it, because sometimes what happens, people actually highlighted their sales and they don't highlight their profits, so people will definitely gonna tend to attract at the sales and will make a wrong decision because of the highlighting. So presentation of accounting statement, the font usage, everything has been told into the end AS. Okay, in the end AS2, it was an inventory, valuation of inventory, how we will go with the LIFO, FIFO, weighted average, with method we need to take, because we wanted to standardize it with the international standard. We actually came up with the solution where we will say that we are going to this adjust our inventories as per this method only. Do we need to take care of the normal loss? Do we need to take care of the abnormal loss? What we will do for the storage cost? Storage cost, what if we are not adding the storage cost into the inventory? What we will do? In AS7, there was a statement of cash flow where we actually see what is the liquidity with the company and what liquidity we are getting from the operating activities, what liquidity I'm getting from the investing activities, what liquidity I'm getting from the financial activities. So in AS7, we are going to discuss about the cash flow statements, how we need to recognize the transaction of which sector. In AS8, accounting policy changes in the estimates and error, where we are actually changing the accounting policies, what we need to disclose into a financial reporting. In AS10, events occurring after reporting period. So there is a period where we report our accounting maybe after the financial year ends. So some events incur in that period, what we need to do in the financial reporting, that will be discussed under the in AS10. In AS11, construction contract omitted by the Company Act, इंडियन अकाउंटिंग स्टैंडर्ड अमेंडमेंट रूल्स 2018 अभी ये आया नहीं है, omitted है अभी भी. In AS12, income taxes, what we do with the income taxes, how to calculate income taxes, how to present it into the P&L, or we need to put it out of the P&L because income tax is not our expenses. In AS16, property, plant and equipment, how to value them at the market value, or if there is some sale and purchase, how to enter it, because the taxation rules are different. But if we are getting good exemption in the taxation, do we need to report it into the financial reporting also? So these are taken care by the in AS16. In AS19 is employee benefit. There are long-term benefits, there are short-term benefits, are also taken care with the IDAS. In 20, accounting of a government grant and disclosure of a government assistance. How the government assistance given as per the sales, revenue, expenses, or maybe for the asset, how to record that, how to recognize that, that will be taken care with the IDAS 20. Now comes to the 21. What 21 says, it says about the foreign exchange. As per the India is developing country, we are actually doing so much cross-border businesses. We are exchanging dollars, pounds with the Indian rupees. So these rates are changing on the daily basis. How we will report any profit or loss in transaction of exchange of foreign currency. Okay, next is Indian AS 23, borrowing cost. Borrowing cost consists of not only interest, but also there are some guarantees cost, what to do with these costs, how to represent it, how to we can justify the borrowing cost if we are borrowing from any bank or NBFC or any personal. We need to recognize it as per short term and long term, and then we will report it as per the Ind AS 20. 24, we are talking about the related party transaction. Who are the related party? Are the subsidiary, holding, or associate companies, or maybe joint venture. And sometimes the related parties are also employer-employee relationships are also taken, blood relations also taken, directors also taken into the related party transaction. Key managerial person comes into the related party transaction if we are doing anything which is not incorporated in the contract of service. Now comes to the 27 in AS, separate financial statements. What the separate financial statement? They are talking about separate financial statement for every division, for every holding company, for every subsidiary company. Then we will consolidate it as per the for the financial reporting purpose, but we will somewhere make separate financial statements for every organization, every company. Ind AS 28 tells the associate and joint venture how to do the investments in associate and joint venture, how to get return out of the investment, how to report these investments, and how to report these joint ventures into the financial statements. In 29, financial reporting in hyperinflationary economics. What is inflationary economic? When the economy, like the country's economy is somewhere declining because of the decline in the value of their own currency, it will definitely gonna.
Ma'am, you're on mute.
Sorry, sorry. Am I audible now?
Yes.
Okay. So we are going to discuss about the separate, we were talking about the hyperinflationary economics. What is inflationary economic? When the currency value is declining at a very speedy form, that is called inflationary economic. So financial reporting in hyperinflationary economics is actually we are trying to cope up with the international standard where we are trying to give the actual value of the good what we have purchased in what price, and now we are somewhere my money value is decreasing, that's why my increase of assets are coming into the accounts. Okay, next is financial instrument presentation. Wow, how to report the financial instrument. The companies actually somewhere made some investment into some instrument which will give them a good balance sheet, as well as they are giving them to park some extra amount which is available with them, or some extra cash and cash equivalent, as well as they are giving returns also. So financial instruments are also part of the balance sheet. How to report earning per share, how to calculate the earning per share, how to calculate profits for the shareholder, where I am actually looking into the what is I have reserved, what I am distributing, that is been taken care with the Ind AS 33. Now comes to the section Ind AS 34, interim financial reporting. Interim financial reporting can be demanded, as well as actually it is given before the financial year ends, and it actually gives you the full replica of the final financial reporting, but it has a somewhere leniency that you don't need to give a notes to accounts. You have to give the accounts, you have to give the financial statement, you have to give the details, but not into the bifurcation everything. Next is impairment of the asset. There could be possibility that asset can be out of work and asset can decline the value, or maybe it is not able to work at all. So in this scenario, we are how to calculate the loss due to impairment of assets are taken care by the Ind AS 636. Now comes to discuss with the Ind AS 1, presentation of financial statement in little depth. Okay, so Ind AS, basically the standard requires an entity to present a complete set of financial statement at least annually, with comparatively accounts with the preceding year, where we actually compare the accounts with the previous year. Okay, so what happened in Ind AS prescribed basis of presentation of general purpose financial statement to ensure comparability both with entities financial statement of previous period with financial statement of other entities. Okay, so it sets out overall requirement for presentation of financial statement, guidelines for their structure, and minimum requirement for their content. The complete set of financial statement, what it consists: firstly, balance sheet for the period as well as for the previous year. Next is profit and loss, This is also for the financial year as well as for the preceding year. Next is changes in the equity of the period. My capital structure has improved, or somewhere I have changed the equity in the period. I have to mention it in my financial statement. Next is cash flow statement of the period. Notes to accounts, where I need to put material accounting policies which I'm following, like I'm following cash accounting system, or maybe I am choosing the accrual accounting system. I need to explain it, the whole information in a very concise way where I could pass the information also. Comparatively, information in respect to preceding period is also there. A balance sheet is in the beginning of the preceding financial period when the entity applied an accounting policy retrospectively, make a retrospective restatement to item the financial statement, or when it reclassified item in the financial statement. What this line means, it means that if I am the Ind AS is applicable on me now, I have to make accounting statement as per the retrospective value. What if Ind AS was in the start also? So I have to take the opening balances also for retrospective effect and have to somewhere make changes in the previous balance sheet as well. However, an entity shall present with equal prominence all the financial statement in the complete set of financial statement. Okay, then the standard requires to entity to present in a statement of change in equity all owners changes in equity, all non-owner changes in equity, comprehensive income are required to present it in single statement of profit and loss, with profit and loss and other comprehensive income presented. Okay, the standard requires that an entity whose financial statement comply with Ind AS must make an explicit and unreserved statement for such compliance in the notes. The entity must not describe financial statement as complying with the Ind AS unless they comply with all the requirements of Ind AS. The application of Ind AS with additional disclosure with necessity, it is presumed to result in the financial statement that achieve a presentation of true and fair view. So next this comes with the materiality and aggregation. So materiality, I told you that is it important? The 300 rupees in 400 crores turnover is not important. So we need to see, is this materiality and aggregation also, where we are aggregating all the amount with each other. What we entity shall present separately each material class of the similar item. An entity shall present separately item of the dissimilar nature or function unless they are immaterial except when required by the law. So now we are coming into the Ind AS valuation of inventory. We are going with the inventory. It's more likely to be AS2 was the same like this, but there are small changes where we are including the AS109, AS32, AS11, AS41 also for the calculation of inventory into the business. What happened into the business? Inventories are asset held for sale in the ordinary course of business. In the process of production for such sale, or in the form of material or supplied to the consumed in the production process or in the rendering of service. Okay, so material is actually valued because I wanted to make a sale out of it, where I wanted to make a profit on it or not. Okay, so Ind AS applies to the inventory except financial instrument, because financial instrument has a different AS like 32 and 109 for financial instrument. Okay, there is a AS11 for biological asset, living animals and plant. There is a AS11 for 41 for agricultural produce. So for them, the inventory will be calculated as per their own relevant AS. But here, inventory constitute a major portion in current asset of an entity. A primary issue in accounting for inventory is an amount of cost to be recognized as an asset and carried forward until related to revenue are recognized. Accounting treatment for inventory such as determination of cost, its subsequent recognition of expenses, including any write down of the inventory or net realizable value and reversal of write down. Okay, so that was the Ind AS. Here what happens in inventories, net realizable value is estimated selling price in an ordinary course of business less estimated cost as completion of estimated cost necessary to make sales. Estimates of net realizable value are based on most reliable evidence available at the time of estimate are made for amount inventories are expected to realize. Okay, what happened here? Cost of inventory comprise all cost of purchase, cost of conversion, other costs incurred in the bringing inventories. If I am paying freight to bring the inventories to my factory area, I will add it to my stock. I will add it to my inventory for their present location and condition. If I need to put some AC, I need to pay something to make it store to keep its value intact. I have to do some expenses that will also be included into the inventory. What is the cost formula? The cost of inventory shall be assigned to the FIFO and weighted average method. इन दोनों में से कुछ ले सकते हैं आप. An entity shall use some cost formula for all inventories having a similar nature and used to be entity. You can't say that is this month I'm taking this FIFO method, next month I'm taking weighted average method. I have to decide it and I have to put it in my financial reporting as per the accounting standard one. Okay, sorry, that accounting standard one in AS. Okay, so I have to understand this, that I have to recognize it, I have to declare it, recognize an expense. Now I have to see that if inventory is sold, carrying amount of inventory shall be recognized as a expense in the period which related revenue is recognized. The amount of any write down to net realizable value or less losses of inventory. It can be normal loss, it can be abnormal loss, shall be recognized as an expense in the period which the write down or loss occurred. The amount of any reversal or any write down of inventory arising from increase in net realizable value shall be recognized as reduction. The amount of inventory recognized as an expense on the period in which reversal occur. Okay, so next I come with the Ind AS 7 statement of cash flow statement. So what is the objective of cash flow statement? We actually somewhere wanted to know, am I getting a profit? Am I getting a cash from where? I do have a cash. From where I'm getting a cash? I'm getting it from operating items. Is my actual business, or maybe from the investing where I have put some financial instrument, or I have invested in different sectors where I'm getting interest, dividend, or anything, or maybe from the financial activities where I am putting financial activities like equity. I'm issuing the issue of shares. I'm doing for the cash purpose. So I have to understand where I'm getting the cash for the business purpose. So prescribed principle that guidance on the preparation presentation of cash flow statement and entity from operating, investing in financial activities for the reporting period. Okay, it is information about cash flow of an entity is useful providing user a financial statement with the basis of asset and ability to entity to generate cash and cash equivalent and the need of the entity to utilize those cash flow, the economic decisions that are taken by the user required to evaluate of the ability of an entity to generate cash or cash equivalent. Okay, and the timing and certainty of the generation. This has also been taken care with this. Okay, objective of AS is to provide information about historical changes in cash and cash equivalent of an entity during the reporting period from its operating, investing, and financing activities. Cash flow or inflow and outflow of the cash equivalent. Cash comprises the cash in hand as well as demand deposits. Cash equivalent are short-term, highly liquid investment that are readily convertible to no amount of cash, which are subject to insignificant risk of change in the value. Cash and cash equivalent include demand deposits, certain short-term investment, and in some cases bank overdraft also. Okay, so that is my cash flow statement. How I came with the operating, investing, and financial statement. The operating activities are principally our business activity for what the company is working for, what primarily activity of the company. That is my operating activity. They are principal revenue producing activity of an entity. I'm not here to for issue of share. I'm not here for making selling my assets. I'm here to produce goods, sell them into the market, and getting cash from them. So sales is the best example for the operating activity. Other activity that are not investing or financing. Okay, cash flow from operating activities are primarily derived from the principal revenue producing activity of the entity. However, under indirect method, there are two methods, which is direct and indirect method. Therefore, they generally result from the transaction and other event that enter into determination of the profit and loss. The amount of cash flow arising from operating activity is a key indicator of extent to which the operations of the entity have generated sufficient cash flow to repay loan or not, maintain the operating capacity or not, pay dividend on time or not, make new investment or not, without recourse the external source of financing. The company is able to do anything without anything outside funds. An entity shall report cash flow from operating activities using either the direct method or indirect method. Under direct method, major classes of gross cash received and payable are presented. However, under indirect method, profit and loss is adjusted for the effect of transaction for the non-cash nature, as well as deferred and accrual of past or future operating cash received and payment, and items of income and expense associated with investing, financing activities. Okay, so cash flow arising from the tax on income uh, shall be separately disclosed and classified such as a cash flow from operating activities unless they are specifically identified with the financial or investing activities. So next point is investing activities. What is the investing activities? Investing activities are the acquisition and disposal of long-term asset and other investment, not included the cash equivalent. So in the asset, if I go to the balance sheet, there is a asset side where the cash is also written. So I'm not going to return that a cash from the investing activity. That cash and cash equivalent will be removed for calculating the investing activities, long-term assets. Okay, the separate disclosure for cash flow arising from the investing activity is important because the cash flow represent that extent to which expenditure have been made for resource intent to generate profit, future income, and cash flow. Okay, and aggregate cash flow arising from obtaining or losing control of subsidiary or other businesses shall be presented separately and classified investing activities. Next comes the financing activity. Okay, now the financing activities are activities that result in changes in the size and composition of the contributed equity and borrowing of the equity, borrowing of the entity. Okay, the separate disclosure for cash flow arising from financial activities important because it is useful for prediction claim in the future cash flow by the providers of the capital of the entity. They will get to know now if I am putting my money, what they are doing, how much money they needed for this much sale only, what they are needed for. This is also important. Okay, an entity shall report separately major class of gross cash received and gross cash payment arising from the investing and financing activities. Now comes to the next in AS, which is 8. What they say, accounting policies, change in accounting estimates and error. If there is any problem, if there is something comes after reporting or after estimation, what will we do? Okay, so firstly, in a specific the criteria of changing the accounting policies together with the accounting treatment and disclosure of the changes. So you have to tell that I was using this accounting policy and that I am changing from that to this. And if I am changing to this policy, what will be the impact on my financial statement of this? Why I am changing it? So you have to tell changes in the accounting policy, changes in the accounting estimate, and correction in the error. The standard is intent to enhance the relevance and reliability of the entity financial statement. Otherwise, people will what do they do? They will change it every day. They will change it every day, and they will not show what is the result, what is the outcome of this changes. So this standard make them mandate to disclose all these things. The comparability of those financial statement over the time with the financial statement of the other entities. The disclosure requires in respect of change in accounting policies are set out in Ind AS. Other disclosure requirement of accounting policy are led into the Ind AS 1, presentation of financial statement, when to present, notes to accounts made, how to present it. That is disclosure that is mentioned into the Ind AS. Next, we come with the Ind AS 10, event after the reporting period. What is the reporting period? Reporting period is the financial year. Financial year is what? From the 1st April to 31st March. So objective, what they are doing when the entity should adjust its financial statement for this event after the reporting period. Some event came after the reporting period, but it is related to the financial period. Okay, so that what we do with that, the disclosures that entity should give about date when the financial statement were approved for the issue and about event after the reporting period. The standard also requires that an entity should not prepare its financial statement on a going concern basis if event after the reporting period indicates that the going concern assumption is not appropriate. So what they say, you can't say that it's a going concern and we will put it into the next year. No, if this expense or this event is related to the previous financial year, we need to go back and report it as the previous year. Okay, so this was here. Okay, events after the reporting period for those favorable can be, unfavorable can be, that can occur between the end of the reporting period and the date when the financial statements are approved by the board of directors in case of the company and by the corresponding approving authority in case may other entity. Two types of event can be identified: those that provided evidence of condition that existed at the time end of the reporting period, that adjusting event after the reporting period, so we can adjust it. But those that indicates of a condition that across after the reporting period, that is non-adjusted event after the reporting period, so we will take it to the next balance sheet or next reporting. Okay, next is Ind AS 12. Next is Ind AS 12. Okay, what Ind AS 12 is? It's for the income tax expense, how to make an income tax expense, how to report it. Ind AS 12 prescribe the accounting treatment for income tax for the purpose of standard income tax, include all domestic and foreign taxes. Okay, so which are based on the taxable profit. So income tax also include taxes such as withholding taxes, which are payable by a subsidiary, associate, or joint venture on the distribution of the reporting entity. So what happened? Principal issue in accounting of income tax is how to account a current and future tax. So what we do, we actually create a deferred tax. We actually create an actual tax expense. So we minus it somewhere. So that is been told us to do the reporting of deferred tax. They have told us to do the reporting of income tax this year. Okay, so future recovery statement of carrying amount of asset or liability that are recognized in an entity's balance sheet and transaction and other event of the accounting period that are recognized in the entity's financial statement. it is inherent in recognition of an asset or the liability that the reporting entity expect to recover or settle the carrying amount of that asset or liability. Okay, so if it is possible that recovery or statement of that carrying amount will make future tax payment larger or smaller, then they would be into such recovery or settlement will have no tax consequences. This standard requires an entity to recognize a deferred tax liability so that I can make a deferred tax asset with certain limited expectations. So exceptions. So where what we do, we make a profit, we make a tax, and we see uh, what tax is payable by me. So I will minus that only. Okay, so it will become an asset for my balance sheet. Next comes to Ind AS 16. Ind AS 16 for PPE. We called it PPE, property, plant and equipment. What happened, what we do is in this, we actually say that probable of the future economic benefit is associated with the entity and the cost of item is measured reliably. The property, plant and equipment are recognized as an asset or determine the carrying amount and depreciation charges, because the depreciation in uh, tax is different and in the Company Act is different. The Company Act implemented in the AS 60. So we have to see, are we are recognizing property, plant and equipment as a asset or not? Because in some cases in accounting, while we do the tax accounting, we take some of the equipment, some of the plants as our revenue expenditure as per the government facilities to us to somewhere decline our profit so that we will end up by paying less taxes. So it is not the part of the accounting where we are doing a reporting to the stakeholders. So, this machinery is not a expense which is revenue. Okay, so this is an asset. So we need to see that plant and equipment so that user's financial statement can discern the information about the entity's investment in the property, plant, and equipment and change in such investment. The principal issue in accounting for property, plant, and equipment are that recognized as an asset as determination of their carrying account and depreciation charges and impairment of losses, which I told you, the impairment of any asset will be there also in recognized in relation to property, plant, equipment, and the tangible item. We can see that. We can see it in it is presented in the system. Okay, are held for use in the production or supply of goods or not, for rental or other, or for the administrative purpose. So we need to see that this is a property, plant, and equipment. We are expected to be used during more than one period. So if it is a long term, then only we will consider it as a asset. Cost of an item of a property, plant, equipment should be recognized as an asset, and if only if it is probable that future economic benefit, this machinery will give me generate production associated with the items which flow to the entity, and the cost of item can be measured reliably. So I could take it in AS for the PPE. Okay. Next I comes to in AS 19, that is employee benefit. Employee benefit. What the employee benefit, what it means? It basically means about the employee benefit, which is short term, which is long term, the salaries, the PF, everything with canteen facility need to be accounted as per the employee benefit, what we are doing. Okay, so employee benefit are all forms of consideration given by an entity in exchange of service rendered by the employees or for the termination of employment. So if I am giving a employee a termination, I am supposed to give him 3 months salary. So in this 3 months salary, I need to also taken care into the employee benefit account. The objective standard is to prescribe the accounting and disclosure of the employee benefit. The standard requires an entity to recognize a liability when an employee has provided service in exchange of employee benefits to be paid in the future. Also, an expense when the entity consumed the economic benefit arising from the service provided by an employee in exchange of employee benefit. The standard shall be applied by the employer in accounting for all employee benefit except those which are in AS 102 share-based profit payment. Okay, so वहाँ पे that will not be applicable. Next come in AS 20 accounting for government grant and disclosure of the government assistance. Okay, so we are here, we can understand here what government grants are. Government give us for something obviously which will comes as a asset or which will comes as a income. Okay, so if the government is giving us some grant for the purpose of buying a machinery, it will definitely gonna go in my balance sheet. But if government is giving me a simple revenue grant, which is like export benefit or something which is like if I will sell this much amount to someone, I will get this amount from the government. So I am getting it as a revenue basis. So that will go in my P&L. Okay, this standard shall be applied in accounting for and in the disclosure of government grant and in the disclosure of other forms of government assistance also. Okay, so government grant are assisted by the government in form of transfer of resources to the entity in return of past or future compliance with certain conditions. For example, the government is giving you land for hospital services, which you will provide to needy people in future. So there is a land is given to you. The grant is assisted by the resources. The land is given to you for the free to build a hospital. So this land will come to your asset side as well as government grant will come to your liability side. Okay, operating activity. They exclude those form of government assistance which cannot be reasonably have a value placed upon them and transaction with government which cannot be distinguished from the normal trading transaction of the entity. Okay, so government assistance is action by government designed to provide an economy benefit specific to the entity or range of the entities qualifying under section certain area. Okay, government assistance for the purpose of its standard does not include benefit provided only indirectly through the action affecting generally trading condition such as provision of infrastructure in the development area or the imposing of the trading constant in the competitor. So that is the government grant implementation and the accounting for that. Okay, next we are going to discuss about the Ind AS 21, the effect of change in foreign exchange rate. As we are going out of the globe to do the business, as we are going globally, and we wanted to improve our import as sorry, we wanted to improve our export. We actually wanted to be okay. We actually wanted to go global for the business purpose. So definitely this will end up by changing the currency with each other. And if I am changing the currency with each other countries, the exchange fluctuation will definitely gonna impact my P&L. Okay, so what will I do if I do have an exchange loss? What will I have to do if I have an exchange profit? So what happen? An entity may carry a foreign activities in two ways. It may be transaction in foreign currencies or it may be have a foreign operations. In addition, an entity may present its financial statement in a foreign currency. The objective of Ind AS 21 is to prescribe how to include foreign currency transaction and a foreign operation in the financial statement of an entity and how to translate financial statement into the presentation currency. For example, if I am putting my all the business in dollars or in pound or any other currency, okay, so I have to at the end convert it into the rupees because this is my presentation currency. Okay, the principal issue are which exchange rates to use and how to report the effect of changes in exchange rates in the financial statement. The standard does not apply to hedge accounting of financial foreign currency item. So this is not a some hedging techniques where I am managing my foreign exchange. No, 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 no. This is a something which already happened, and I am doing the accounting. Include the hedging of net investment in the foreign operations. Okay. In AS 109 is also there to applies on the hedge accounting. This standard does not apply to the presentation of statement of cash flow arising from transaction in a foreign currency or to the translation of the cash flow of foreign operations. Okay. And AS7 statement of cash flow also doesn't entertain this. Okay. This standard does not also apply for a long-term foreign currency monetary item for which an entity has opted for the exemption given in the paragraph D13 of Appendix A of Ind AS 101. Ind AS 101 also present implementation of Ind AS. Okay, such an entity may continue to apply the accounting policy so opted for a such long foreign currency monetary item. Next, we are going to discuss about the Ind AS 23. Ind AS 23. What the Ind AS 23 tells about the borrowing cost. What is the borrowing cost? Borrowing cost are the interest or other costs that entity incurred in connection with the borrowing of the funds. The funds is what I need cash. I need money to operate something, or I need some asset to be buy. I will borrow the money from the market or maybe from the bank or maybe from the person. Okay, so borrowing costs that are directly attributed to the acquisition, construction, and production of the qualifying asset from part of the cost of that asset. Other borrowing costs are recognized as an expense. Other borrowing costs will be taken as an expense. Okay, but if I have purchased a machinery which is not put into the work, then I will put all the expenses to the machinery only. I will add all the machinery, all the expenses to the machinery, and it will be depreciated over a time as per the standard. Okay. Next, an entity shall cease capitalizing borrowing cost when substantially all the activities necessary to prepare the qualifying asset for the intended use or sale are complete. Okay. An entity shall disclose the amount of borrowing cost capitalized during the period. So we have to tell them that this borrowing cost I have capitalized, it is into the balance sheet with the machinery and everything. But the capitalization rate used to determine the amount of borrowing cost eligible for capitalization. Okay, so these are the things I have to see and I have to disclose while I am calculating the borrowing cost, or I have a transaction into the borrowing cost. Okay, next we are going to discuss about Ind AS 24 related party disclosure. What is the related party firstly? Related party is anyone I'm having a relation. For example, if the director and the company has a relation, employer-employee has a relation, as well as director of this company with the partner in another firm, that firm will be related to this company only. So what happens here, if you are doing any guarantee for the company, then you are also a related party of the company. Okay. This objective of Ind AS 24 is to ensure that an entity's financial statement contain the disclosure necessarily to draw attention to the possibility that its financial position and profit and loss may have been affected by the existence of related party transaction, by transaction and outstanding balances also, including commitments and parties. So if I have paid some extra money to my any related party, or I have done some sale or purchase to related party, I have to report it on my financial statement. It is mandatory, even in the cost audit also. Okay. So related party disclosure requirements as are laid down in the standard do not apply to circumstances where providing such disclosure would conflict the reporting entity duty and confidentiality as are specifically required through the terms and statute or by any regulator or similar competent authority. So if we are into the defense, we are providing defense ships, and they are related in some areas as well. So we can't disclose the confidential reports to their costing and everything. But yes, we have to mention them. Okay. In case of statute or regulator or a similar competent authority governing to entity or prohibit entity to disclose certain information which is required to be disclosed as per this section or this standard. Okay. So disclosure of such information is not warranted. For example, banks are obliged to law to maintain confidentiality in respect of their customers' transaction, and the standard would not override the obligation to preserve the confidentiality of customers dealing. Okay, so I have to see here also these part. Okay, an entity shall disclose the key managerial person compensation in total and for each of the following category. First, short-term employee benefit if I'm giving, post-employment benefit, other long-term benefit, termination benefit, and share-based payment. I have to look into the related party transaction only. Next, we are going to discuss about the Ind AS 27. Ind AS 27, separate financial statement. What the separate financial statement? Separate balance sheet statement for the subsidiary, joint venture, associate, or any entity which is by the law is related to you. Okay, so in objective of a Ind AS 27 is to prescribe the accounting and disclosure requirement for investment in subsidiary, for investment in joint venture and associate companies when an entity prepares separate financial statement. The standard shall be applied in accounting for investment in the subsidiary, joint venture, associate when an entity elect or is required by law to present separate financial statement. Okay, so separate financial statement are those presented by the parent company. By the parent company, it can be an investor to control a subsidiary. Okay, or an investor with the joint control or significant influence over the investee, in which the investments are accounted for at cost or accordance with the Ind AS 109. Okay, financial instrument also. When an entity prepares separate financial statement, it shall account for investment in subsidiary, joint venture, and associate either at cost. Yeah, so you are going for the cost because we have taken care with the cost that I have paid this much amount and it is a cost. And there is a standard which is 109 Ind AS. Okay. So what they say, they actually tell us about the financial instrument. Ind AS 109 requires that a financial asset, except a certain trade receivables or a financial liability, should be measured at initial recognition at its fair value plus or minus. So fair value plus or minus for the financial asset or financial liability, not subsequently measured by this transaction that are directly attributed to the asset. Okay, to the financial instrument. So a fair value can be taken, but you have to decide it and you have to report it as per the Ind AS 1. So this 109 comes with this AS 27 also. Next comes with the Ind AS investment in associate and in joint ventures. The objective of Ind AS 28 is to prescribe the accounting for financial instrument in associate and to set out the requirement for the application of the equity method when accounting for investing in associate and joint venture. The standard shall be applied by all entities that are investor with joint control of or significant influence over the investee. Okay, an associate is entity over the associate is entity over which the investor has significant influence. Okay, significant influence, the power to participate in financial and operating policy decision making. What is a significant? Where I have a 20% or more voting rights or equity power, that is taken as a significant influence. So if an entity hold directly or indirectly through subsidiary or by themselves, okay, 20% or more of a voting power in the investee, it is presumed that the entity has significant influence unless it can be clearly demonstrated that this is not the case. Okay. Conversely, it is entity hold directly or indirectly through subsidiary less than 20% of the voting right to the investee. It is presumed that the entity does not have any significant influence unless such influence can be clearly demonstrated. A substantial or majority ownership by the another investor does not necessarily preclude an entity for having a significant influence. Okay. Now comes to Ind AS 29, financial reporting in hyperinflationary economy. As I told you, that inflation and hyperinflation is there. Okay, so if we talk about India, it is an inflationary economics. But there are some economies which are hyper economy, where you can't even imagine what happens next, what will happen next. So in AS 29 shall be applied to financial statement, including consolidated financial statement of any entity whose functional currency is functional currency is currency of a hyperinflationary economy. Okay, so the standard does not establish an absolute rate at which hyperinflationary is deemed to be arrivals. It is a matter of judgment where I need to decide that is it or is it not. So I have to make a judgment over this is a Pakistani currency, it is highly inflationary. So I will see ki, okay, when restatement of financial statement in the accordance with this standard becomes necessary. Okay, hyperinflationary is an indication of characteristics of economic environment of a country, which includes but not limited to following. So we can see general population prefers to keep its wealth in a non-monetary assets. For example, they don't want to keep a cash, they don't want to keep a shares, they don't want to keep any mutual fund. They relatively stable foreign currency amount of local currency held are immediate investor to maintain the purchasing power. Okay. Generally, population regards monetary amount not in the terms of local currency, but in the term of relatively stable foreign currency. Where I am buying dollars, I am, if you can see, if anyone have been in the Nepal, the Indian currencies are kept with themselves. So prices may be quoted in that currency. Okay. Sales and purchases on credit take place at prices that compensate for expected loss of the purchasing power during credit period, even if period is short. Interest rate, wages and prices are linked to the price index. Okay, this is also there. Next is cumulative index rate over 3 years is approaching or exceed 100%. So these are the areas which a person take judgment, and by these factors relating to, do I need to think of this? So what I do, I make a little provision for this. So this is happen in the financial reporting in hyperinflationary economies. Okay. So next is Ind AS 32. 32, what the Ind AS 32 tells, financial instrument presentation. The objective of Ind AS 32 is to establish principle for presenting financial instrument as a liability or equity, and for offsetting financial asset and financial liabilities. It applies to the classification of financial instrument from the perspective of a issuer to financial asset, okay, financial liability and equity instrument. So I am buying a asset, but I am giving them a equity share. Okay, the classification is related interest, dividend, loss and gains, and the circumstances in financial assets and financial liabilities should be offset. They should be offset together. Okay, the principle of standard com complement with the principle of recognizing measure financial asset and financial liability with AS 109, which is financial instrument, as well as disclosing information about the 1071, that is also financial instrument disclosures. Okay, this standard defines financial instrument, financial asset, financial liability, equity instrument, putable financial instrument. So these is totally depend upon the how I purchase and sell my assets with the financial instrument. This is here. Okay, next is my earning per share. Earning per share. Okay, the objective of Ind AS 33 is to prescribe principle for the determination and presentation of earning per share. So as to improve performance comparisons between different entities in the same reporting period and between different reporting period for the same entity, the focus of standard is to denominator of the earning per share calculation. So we actually wanted to know what is the earning per share last year and what is the earning per share this year, or this is the earning per share of this company and this is the earning per share of that company. So that is there, so that the stakeholder can take the decision where he can understand that the earning per share is there, this in this company. Okay, so in AS 33 shall be applied to a company that have issued ordinary share to which Indian accounting standard notified under the Company Act applies. Okay, an ordinary share is an equity instrument that is subordinate to all other classes of equity. A potential ordinary share is a financial instrument or other contract that may entitle its holder or ordinary shares. An entity shall present in statement of profit and loss basic diluted earning per share for profit and loss from continuing operation attributable to the ordinary equity holder for the parent entity, and for the profit and loss attributed to the ordinary equity holder for the of the parent entity. Okay, so what happened? An entity shall present basic and diluted earning per share with equal prominence of all period presented, so that a person can take a good decision why they should invest in the company. Are they making any profit? What is the cost of my share? What earning the share is company making, and what is the investment? Okay. Next is interim financial reporting. Interim financial reporting. What is the interim financial reporting? As I told you, this is actually basically the mid. That is a mid, which I am making an interim financial reporting, which is not recognizable in the end of the year. Okay, the objective of Ind AS 34 is to prescribe a minimum content of interim financial reporting and to prescribe the principle of recognition and measurement to complete or condensed financial statement for an interim period. It can be quarterly, it can be 6 months. Okay. Timely and reliability of interim financial reporting improves the ability of investor, creditor, and other to understand the entity's capacity to generate earning and the cash flow and its financial condition and liquidity at the end of the year. Okay, the standard applies if an entity is required to or elect to publish the interim report or not according to the Indian accounting standard. Okay, interim financial report means the financial report containing either a complete set of financial statement as described by the NDS presentation of financial statement or a set of condensed financial statement. What is a condensed financial statement where we are not giving you the every details? We are not giving you in-depth detail, but we are giving you heading wise figures into this. So condensed as described in the standard or for an interim period. Okay. Next is impairment of asset. This is the last accounting standard we are going to discuss today. It is Ind AS 36, impairment of asset. Objective of this prescribed procedure, that is entity applies to ensure that its assets are carried at no more than the recoverable amount. So we wanted our balance sheet to be at the amount where it can be realized, the asset can be realized. Why we are doing this? There could be many reasons. In this case, asset is described as impairable and standard required entity to recognize the impairment loss also. Standard also specifies when an entity should reverse an impairment loss and prescribe disclosure. Okay, so an entity shall arise at the end of each reporting period whether there is any indication that an asset may be impaired. If any such indication exists, entity shall estimate recoverable value of asset. However, irrespective of whether there is any indication of impairment, an entity shall also test an intangible asset with an indefined useful life or an intangible asset not yet available for use of impairment annually by comparing its carrying amount with the recoverable amount. So we need to see what is the resale value. If it is revocable, it is a full return down value in the books minus recoverable, whatever comes, that will be my impairable loss. This impairment test may be performed at any time during an annual period, provided it is performed at the same time every year. Okay, different intangible asset may be tested for impairment at different times. However, if such an intangible asset was initially recognized during the current annual period, that intangible asset shall not be tested for impairment before the end of the current annual year. Test goodwill acquired in the business combination for impairment annually in the accordance with the standard. So these are the accounting standard I have taken care today with the introduction. Is there any question?
Any questions, please? Ma'am, can we conclude?
Yes, yes.
Yeah, thank you.
Thank you so much. Thank you so much for going with this. Okay. Thank you so much.
Yeah, see you tomorrow, ma'am. Yeah.
Yes.